I remember a time I was in the airport and I got an email from someone I had met briefly, him and his wife, and he was considering a high cash value life insurance policy, and he had emailed me a policy that someone else had shared with him, an illustration, someone he was talking to, and his question was, hey, I'm looking at it, it looks okay, but something just don't look right. Am I being taken advantage of? He didn't put, am I taking advantage of in the email, he phrased it in a different way. But a concern of his was, when I open this policy, I'm interested in the cash value. That's it. The death benefit, long-term, I love that idea from a legacy standpoint, but Steve, the cash value, that's my goal. I do not want to be taken advantage of. He had just worked for a large part of his life. He was in his late 40s when he started the policy, but he is able to save a ton of money now. You're going to see $300,000 per year just in cash value life insurance because he had worked his whole life up until that point on paying off his debt, personal debt, business debt, everything. He is completely debt-free and has a very high savings rate. He was plowing everything towards his debt for a long period of time, and now he's got no stress from a financial situation, no debt. He just saves his cash flow, and then in the policy, he can use it for whatever he wants as well. But again, going back to the story here, he did not want to be taken advantage of. That was his main concern, didn't want buyer's remorse. And here's the big thing. So sometimes people are direct about it, sometimes they're not. When I say people we work with is, hey, Steve, IBC Global, we were shown a policy. What's the agent making commission? Because I don't feel like it's the best option. And I expressed to my agent, to the company I'm working with, that cash value is what I'm interested in. Am I getting a true high cash value policy? Am I being shown all the options? This individual wanted to see options. We showed several options. You're going to see that as we go through everything here. So let's take a look. First and foremost, what to look for when opening a policy if maximum cash value is your goal. Number one, policy design, regardless of the company. Money can go where? Toward the premium or PUA component. Company selection. 4 major mutuals, and flexibility. How do I use it as a flexible savings asset, not a bill? To provide a little more detail on this, when done right, when we hear of big banks, corporations, wealthy individuals using high cash value life insurance, here's what it is. Safe, liquid, tax-free area to position money. The growth rate somewhere conservatively, call it between 3 to 5%. That's an effective tax-free yield too if we don't trigger a MEC. Loans and compounding. What that means is your money is always at work for you as if you never touched it in the first place, specifically when you pull money out. If I take a loan out of 100 grand, I still earn dividends and interest on that 100,000 as if I never touched it in the first place. So properly designed policies. Traditional long-term policies typically have between 85 and 90% cash value in the first year. Some have higher than that. You're going to see some examples of that as well. Break-even point, typically between 3 and 5 years, and flexibility. So this individual specifically stated, I remember this conversation with him and his wife, they wanted to be able to pay in up to $300,000 per year. So that's a yearly cash flow figure they want to pay, but they do not want to get a bill for that because cash flow fluctuates. So literally what they did is they have a minimum premium that they pay annually. They even considered doing this monthly. And then at discretion, they just pour more money into PUAs, growing the cash value. 4 major mutual companies, cream of the crop. We're going to see options with both of them. Let's take a look. What they wanted to see was options of funding a policy for 5, 10, and 15 years. The individual is age 48 at policy start date. These are all run at Select Preferred, the second best class. He received the top health class. So the actual numbers with any of these options ended up looking better. But options, you can see it up here. Show me the options, not just one policy with one company. I don't want to see that. I want to know that you know your stuff and I can see different options, pros and cons. This way I do not have buyer's remorse. Not everyone wants to go through this. Some people do. Personally, I like seeing the options. So what we've got, 2 of the 4 major mutual companies Guardian and Mass, and we see a whole life policy with a basic dividend rate applied, and then a whole life policy with an indexed feature applied. Funding, $300,000 for 5 years. These two products on the left are identical. If you've seen our indexed feature whole life videos, you know what I mean. If you haven't, I would encourage you to check those out. That provides a clear breakdown of this being the exact same policy. The policyholder can just decide to switch back and forth. If some years he wants to go dividend, other years indexed, maybe 50-50, 70-30, you can blend it, which is nice. Same guarantee of 4%, same insurance expenses, all that good stuff. But what do we see? Break-even point between years 3 and 4. Same thing here. Long term, the indexed feature does project, keyword project, stronger values, although it is not guaranteed. Compared to another company, we see a traditional whole life product, funded for 5 years. What that means traditional is he can pay into this forever if he wants to, up until age 100. Then we see a high early cash value product. Remember where we talked about more than 90% upfront? If you look at the numbers here, it's about 95% of his payment is in cash value immediately in the first year alone. He's positive, clean, year 3. He's paid in $900,000. He has $900,000 in cash value. A lot of business owners are attracted to these type of products. Where people are not attracted to it is if we look at it at the year 10 mark, where it's the same company with the same dividend rate, same design, we start to see a distinct difference here, where the traditional product is stronger. What's happening here is with a high early cash value life insurance policy, the company is not going to overcharge me for the insurance expenses all up front. Instead, they spread those expenses out over the life of the policy. They're a bit higher and it causes drag on the policy. Dividends are the same. The dividend rate from the insurance company is the same on both products. Dividend treatment is different when you actually break it down though. So we see a difference there. It's an option though he wanted to see. And then we have a limited pay whole life product, which breaks even the latest among these options, year 6. But when we look at it in a 5-year funding scenario, let's look at year 20, 2.855, 2.529, that's a big difference, and 3.23. Different company, same company, different products, same out of pocket to the consumer. This is the kind of stuff he wanted to see up front. Looking at a 5-year fund, he says, what if I go 10? Is there a difference? Yes, there is. Same thing, stretching the funding out for 10 years. These products will look the same with Mass Mutual. With Guardian, we do need to know up front if one wants to have the option to pay into a policy for a longer period of time. Has to do with how we construct that term rider and specifically with the company's PUA limits and their MEC limitations. Know that that's technical, but same thing, out of pocket, just stretching it for 10 years. Limited pay, traditional, high early cash value. Now this limited pay is a 10-pay product, so he can't pay any more than 10 years. After that, if he wants to keep feeding it, premiums are no longer due, although some companies let you pay PUAs in after 10 years. 15 years, 10 pay is not there anymore. What do we notice? Guardian had to stretch the death benefit. Mass, same death benefits up front. If you rewind the video, you'll see very similar designs with these options. HECV, the high early cash value, a couple tweaks, but same break-even points. All we're doing is pumping money in longer. And here's the fun part with this. All of these options, we had a 5, 10, and 15-year funding option. With Mass specifically, we don't need to select that up front. Meaning I might plan to go for 5, but I keep going for 15. Maybe I keep going for 30. With Guardian, you can continue to pay. We do need to have a sense of how long we want to max fund a policy, meaning 10x the base premium, because it will impact how high we need to go in that term rider. Do we qualify for a large death benefit like that? There's some questions we'll ask during the process there. But in any event, the purpose here is this individual wanted a maximum cash value policy. You'll notice all of the options had rich cash values up front, early break-even points, but he wanted to see different funding scenarios with different companies, and different products. Now, he does not run the risk of running into someone else, seeing a different option, perhaps with the same company, and then questioning us to say, okay, Steve, why did you not show me this when we first connected? Because this option you did not show me may have been something I very well would have considered purchasing because I like it, I like these features. That's the kind of stuff we want to be aware of up front. If we have that awareness as a consumer, then we can select the option we want with peace of mind, maximize the cash value, and then use it to the fullest degree possible. Hope you enjoyed this one. Let us know if you have any questions at all, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.